If I told you that one invisible number controls your house price, your car loan, your business growth, your job market, and even the stock market, would you care about it more? Because that number exists, and it's called the interest rate. Most people hear interest rates are up on the news and instantly tune out. It sounds boring, technical, like something only bankers should understand. But here's the truth. Interest rates are the price of money. And when the price of money changes, everything changes. Let's break this down in the simplest way possible. Imagine money is not just cash. Imagine money is a product like fuel. If fuel becomes expensive, transportation becomes expensive, food becomes expensive, travel becomes expensive. Now replace fuel with money. When borrowing money becomes expensive, buying a house becomes expensive, expanding a business becomes expensive, even using a credit card becomes expensive. That's what interest rates do. They decide how expensive money is. Now let's simplify it even more. When you borrow money from a bank, you don't just return the amount you took, you return extra. That extra is called interest. If you borrow $1,000 at 5% interest, you'll pay $50 extra over a year. If the rate becomes 10%, now you pay $100 extra. Same money, different cost. That percentage, that small-looking number, is powerful because when it rises across the entire economy, millions of people start paying more at the same time. But who decides this number? In most countries, it's the central bank. In the United States, it's the Federal Reserve. In the UK, it's the Bank of England. In Pakistan, it's the State Bank of Pakistan. These institutions adjust interest rates to control inflation and stabilize the economy. Now here's where it gets interesting. Why would a central bank increase interest rates? To slow things down. When interest rates are low, borrowing is cheap. People take more loans, businesses expand, consumers spend more, the economy heats up. But if everyone is spending too much, prices start rising rapidly. That's inflation. To cool things down, central banks raise interest rates. When loans become expensive, people borrow less, spending slows down, inflation starts calming down. So raising interest rates is like pressing the brakes on the economy. Lowering interest rates is like pressing the accelerator. But here's the twist most people don't think about. Interest rates don't just affect borrowers, they affect savers too. If you keep your money in a savings account, higher interest rates mean banks pay you more. Suddenly, saving becomes attractive. You earn more without taking risk. When rates are low, saving feels useless. Your money barely grows. This is why interest rates influence behavior. They quietly push people to either spend or save. Now let's connect this to real life. Why do house prices often drop when interest rates rise? Because mortgages become expensive. Imagine someone could afford a $300,000 home when rates were 3%. If rates jump to 7%, their monthly payment increases dramatically. Now maybe they can only afford a $230,000 home. Multiply that by millions of buyers. Demand falls, prices adjust. This is why the property market reacts strongly to rate changes. The same thing happens in the stock market. When interest rates are low, investors look for better returns. Money flows into stocks and businesses because bonds and savings accounts offer low returns. But when interest rates rise, safer investments like government bonds start offering attractive returns. Some investors move money out of stocks. So interest rates influence where money flows in the economy. They affect startups, corporate profits, hiring decisions, and even your job security. Now let's make it practical for you. If interest rates are rising, A. Avoid unnecessary debt. B. Be careful with variable rate loans. C. Focus on managing cash flow. D. Saving becomes more rewarding. If interest rates are falling, A. Borrowing becomes cheaper. B. Businesses may expand. C. Property demand may increase. D. Investments often become more attractive. Understanding this cycle gives you an edge because instead of reacting emotionally to headlines, you start anticipating movements. Now here's something even deeper. Interest rates also affect currency value. When a country raises rates, foreign investors may invest there to earn higher returns. That increases demand for that country's currency. A stronger currency can make imports cheaper, but exports more expensive. So, yes, this one number connects to global trade too. Think about that. One percentage change can influence housing, stocks, jobs, savings, currency, and business growth. That's why I call it the price of money that changes everything. And here's the mindset shift I want you to take away. Don't fear interest rates, track them. When you understand where rates are in the cycle, you stop being surprised by economic shifts. You start preparing instead of panicking. Most people learn about interest rates only after they're already affected, when their loan becomes expensive or when markets crash. Smart people watch them before making big decisions, before buying property, before taking large loans, before expanding a business, before investing heavily. Because money has a cost, and that cost moves. And when the cost of money moves, the entire economy adjusts around it. If this video made something complex feel simple, that's exactly the goal of this channel. Breaking down powerful financial concepts so you can make smarter decisions without a finance theory. If you want more clear, practical finance explanations that actually help you in real life, subscribe and be part of this journey. We're building a community that understands money instead of being controlled by it. And remember, the next time you hear interest rates are rising, you'll know it's not just news, it's the economy shifting gears.